Ready? Hello, good morning everybody. Welcome to Taunton Racecourse and to everybody who's watching at home to the AC Mole and Clarke Willmott Budget Breakfast. So I am Rebecca Oatley. I'm tax partner at AC Mole. Just want to take care of a bit of housekeeping before we start. There's no planned fire drills this morning, so if we hear the fire alarm, can everybody leave down through the stairs of which you came up and congregate outside in the car park. And I'd also just like to say a big thank you to the racecourse for a fantastic breakfast, as always. Thank you very much. So I stood here just over a year ago saying that we were expecting a much anticipated budget. But I think it's safe to say, based on the number of people that we've got here today and the number that we've got watching online, that this one was even more anticipated. Now, was it really a surprise based on the months and months of speculation that we had in the run-up, and actually the toing and froing of, I'm going to do this, I'm not going to do this, and actually when it came to it, and we'll hear from Amanda and Tom, a lot of it didn't come to fruition. So on budget day, we sat down as we normally do, and Amanda messaged me about 30 minutes from the start of the budget to say, it's actually been already released by the OBR. So we're thinking, oops. So we sit down to watch it as we normally do. And I think this is probably unprecedented when you've got the Deputy Speaker of the House actually reprimanding them for their behaviour and all of the leaks and the OBR. So we did have a little bit of a chuckle about that because I think it was long overdue. And I thought, poor Rachel Reeves at this point. I know she's not horribly popular, but I think she probably needed a bit of a drink at that point. And there is a fact, which some of you may know and some of you may not, that actually the Chancellor, when they're delivering the budget, they are allowed to drink alcohol. Now, she definitely wasn't drinking alcohol, and I did check this. And so I checked to see who the last Chancellor was that actually drank alcohol during their budget, and it was Kenneth Clarke. So apparently his drink of choice was whiskey, which was quite common with a lot of them, apart from Winston Churchill, who preferred brandy. But what was also interesting when I had a look at these facts was that Norman Lamont didn't just drink whiskey, he carried a whole bottle in the red box. And he actually put the budget speech in a plastic bag. So I've checked here this morning, no plastic bags for our presentation, no bottles of whiskey that I'm aware of, and, well, just checking. So with that, I will pass over to our two speakers. As normal, we have Amanda Gunter, tax partner at AC Mole, and Tom Chiffers, private client partner at Clarke Willmott. And with that, I will hand over to Amanda.
Thank you, Becky. Morning, everybody. As Becky mentioned, I'm Amanda Gunter. I'm one of the partners at AC Mole. So this morning, I'm going to cover a review of the economy first, and then I'm going to go on and cover the sort of personal taxation side, and then Tom's going to cover our capital taxes. So firstly, as the Chancellor does, we always have a bit of a review of the economy first. If anyone actually watched the budget, you'll always know that she does start off with these areas where she's doing a review. You'll also know that she always puts a positive spin. Every Chancellor does. So I'm going to try and do the same like we normally do, but there may be a few caveats as we go through. So positive, first off, inflation. Well, it's down on what I was saying a few years ago. We've got inflation at 3.6% in October, which was down from 3.8% in September. Now, that's down because a few years ago, we were seeing inflation at 11%. So a positive, inflation's down. Now, what the OBR does, so the Office for Budget Responsibility, they produce their report, which was released early, and that report covers a 5-year forecast. They do the report twice a year, normally in March and then in October, or in this case, November, because it was a late budget. In that forecast, they look at every area. So for inflation, we are forecasting 2.5% for inflation next year. And then from 2027, we are looking at roughly 2% inflation for the remainder of that 5-year forecast. Now, the target inflation rate that the government looks for is 2%. Now, 2% is the rate that the government think is the best for the UK economy. So a positive, we are looking to achieve that target during that 5-year forecast. It's a positive, but I'm going to give you the first caveat. The OBR were predicting that we would achieve our inflation target of 2% much earlier. So they've pushed it back, and our inflation rate hasn't dropped as quickly as everyone was originally hoping and expecting it would. So they have pushed that forecast back. Now, we always look at the base rate, because the base rate is the one tool that can be used to help with inflation. The Bank of England control the base rate, and they are tasked by the government to achieve that 2% inflation rate. Their biggest tool is the base rate. So what we saw, where we saw inflation going up, is that we saw the base rate going up as well. Now, fortunately, I can say another positive, base rates come down. So the base rate has come down to 4%. There were times when base rate was extremely low, borrowing was wonderful, our mortgages were so much cheaper. Now, do we think we are going to get back to those stages? Well, if you look at the OBR report as what they're saying, then they're saying that we might see a slight drop in base rate next year, but not by a lot. Their forecast is actually looking that we will see the base rate around that 4% mark for pretty much the entirety of that 5-year forecast, which I thought was quite interesting. This one's a bit more of a negative, and this is a negative that we've been saying for years. UK growth. The government needs growth. The reason they need growth is because with growth, we pay more tax. So they get more receipts in. So they focus on growth, and it's what they really want to achieve. Our forecast growth, unfortunately, I am saying growth here. I'm not saying that we're seeing negative growth. It is positive. It's forecast at 1.5% for the current year. Now, in the OBR's report, we are looking at that sort of medium-term forecast, and they think growth is going to be around about 1%, pretty much for the entirety of the forecast. Now, what you see if you read the OBR's report is actually the UK is still underperforming in terms of productivity and therefore growth. It's something that the government has been focusing on because they want to see more growth so that they get more tax receipts. Now, I thought it might be interesting to sort of compare our growth, so see if we can throw a positive spin on it, to, say, the global growth. So the IMF, they have forecast global growth at 3.2%. So if you're looking at global growth, we're still not there. But if you think about global growth, that's fairly broad. All right, so it's better to compare it to something a little bit closer to home, shall we say, so other developed economies. Now, if you have a look at Germany, France, other European areas, then actually they've struggled with growth as well. So we're not too far apart, but still slightly sluggish. So the other thing that you always hear about from the Chancellor, if anyone watched the budget on Wednesday, is the words deficit or surplus, as she managed to use this time, our borrowings and our debt. Now, I've got 3 titles there, deficit, borrowing and debt. Now, you'd think a few of them, pretty much they're the same, aren't they? Why am I putting 3 titles? Historically, deficit and borrowing used to be the same thing. As of a couple of years ago, maybe a year and a bit ago, they changed the terms for deficit, which means that then the Chancellor could stand up on Wednesday and say that we were going to show a surplus in 2028-29. Now, I was reading the budget report, 150 pages of it, and as I go through, I'm like, normally I understand what I'm reading, but on one page, I was seeing borrowing, And on a couple of pages later, I was seeing the word surplus. And I thought, hang on a minute, this doesn't make sense. And it's because of the terms. So the deficit is now classified as the amount of money that the government's getting in, less their day-to-day spending. So it excludes capital investment. Now that's why the Chancellor could stand up and say that in 28-29 we're going to show a surplus, because our income will cover our day-to-day spending. But what it doesn't do, it doesn't cover our capital expenditure. And therefore, in every year of the forecast, we will continue to borrow money. All right, so there is now a difference between deficit and borrowing. Now, if we're borrowing every year, what's that doing? Is adding to our total debt. So debt, when everyone's talking about it, that's the total amount that we actually owe. Now, you may have heard some positives in the budget from the Chancellor in relation to our debt. And again, that's just because they are calculating it in a slightly different way. And you'll find that our debt as a percentage of our gross domestic product will reduce over the period of that forecast. So our debt as a percentage of GDP is currently 97%. That's quite high gearing. It's going to drop to 96%. That's a positive. It's still going to go up. That's a negative. Our total debt, £2.7 trillion. So if you've got 2.7 trillion that you owe someone, firstly, you'd be crying. But nextly, you'd be thinking, how much is that costing me in interest? Does anyone know how much our debt costs in interest? 10% of our spending. 10% of our total spending goes on interest payments or debt management payments. It's quite a lot of money. So if you're thinking that's 10%, now our healthcare is obviously our biggest cost when you're looking at spending. Interest is one of the next biggest. Debt management is very high on the agenda when you've got such high debt. Now, to put that into comparison, if you read the OBR report, the one thing it does talk about is that actually the UK has very high debt in comparison to other developed countries, all right? And our percentage of debt to GDP is actually fairly high. It's good to see it going down, but if we're still borrowing in every year of this forecast, debt's going to go up. Interest management is highly important. So as I was going through, I thought, this time we'll have a little bit of a bigger dive into things, because there were some areas I thought might be quite interesting that didn't come across in the budget presentation. Now, in the back of the budget report, so as you get to probably about page 55, there's some really good information in there, which tells you exactly where things are being spent and how much more money they're going to be getting in. And it's quite interesting. Because what you probably didn't get from the budget that is in every year of this forecast, taking into account all of the policy changes that were announced on Wednesday, then our public spending is up. There aren't the savings. And public spending will be up significantly in a lot of those years. Now, you've probably heard a lot about the 2-child limit that was that's where a lot of the costs are actually going. All right, for it. And it was quite interesting to see that public spending was up in every year that they were going to do it. Now, the tax take in every year, I thought you'd be interested to know this. In the first few years, it goes up a little bit. And then in those later years, we start seeing it ramping up a lot. We're going to see why in a minute, because there's some timings to worry about with all of this tax take. Now, the one thing the report's actually said is that actually in 2030-31 is going to be one of the highest points of tax take. It's going to be 38% of GDP, all right, is going to be our tax take. 2030-31 is going to be painful. Now, the net effect of the policy changes that were announced on Wednesday, in the first couple of years, there was no positive effect. All right, so we were spending more than we were taking back in from those tax changes. In the later years, you start to see some significant turnaround. So our tax take in those last 3 years starts covering all of our spending as we're going through and eating into that in the first place. We're going to have a look at where that money is coming from in relation to the tax changes. So what was announced in terms of tax policy changes? The big ones. So we're going to look at personal tax areas. Now, everything was frozen. Now, you've heard this before, that they were going to freeze personal allowances and thresholds. Originally, they were being frozen until 2028. They have extended that freeze to 2031. So the personal allowance, £12,570. How long have I been saying that for? A long time. 9 years? Income tax thresholds, they're going to be frozen until 2031. So we've got our higher rate threshold at 50,270, additional rate threshold 125,140. They're freezing the national insurance thresholds as well. Okay, so they are at the same limits. You may remember our employer's secondary threshold last year was moved to 5,000. That's going to remain the same until 2031. All right. So what else did they announce? Now, this is where you've got to get your timing right. So from 6th of April 2026, we are going to see the dividend tax rate go up by 2%. Okay, this one didn't surprise me. I've probably been saying for the last, 4 years that dividend tax rates are going to go to about 10%. So this one didn't surprise me. Basic rate is going to be 10.75%. Higher rate, 35.75%. Oh, but look, they haven't changed the additional rate. The additional rate stays at 39.35%. Okay, that one surprised me because I thought they would just do it 2% on all of them. What else is happening on 6th of April 2026? Well, I mentioned about growth. So the government want growth, and they think that things like EMI, EIS and VCTs will help with the development of younger businesses and developing businesses. So they've actually broadened the eligibility criteria so that the more companies will be able to benefit from EMI, EIS and VCTs. But this bit surprised me. You give with one hand and you take back a little bit with the other. So the income tax relief on VCT investments is going to drop. It was at 20%, it was at 30%, and it's dropping down to 20%. So that's 1 year dealt with. Now we've got another one to worry about. So from 6th of April 2027, we're going to see another increase in tax. So on savings income and property income, tax rates are going to go up by 2%. Now, you'll notice I've put in there, it's a little bit of a quirk. It says property income will have its own income tax rates. Now, for the tax techs here, so my colleague Rebecca, she'll know that if you have things like earned income, savings income, and now property income, they actually have different tax rates. Now, by that, historically, we had tax rates of 20%, 40%, 45%. But if you were doing a tax computation, you actually have to separate them all out and tax them at different rates, which is why there's a bit of a technical point there that property income will have its own tax rate. What will they be? Basic rate for that will be 22%, higher rate 42%, and additional rate 47%. So we'll see here they did put the 2% on the additional rate. And one other thing a big announcement they made that you may not have thought was a big announcement at the time, but it is. From April 2029, salary sacrifice pension contributions are going to be changed. So currently, salary sacrifice pension contributions benefit from relief from national insurance. So there's no employee and no employer national insurance contributions on them. From 2029, going to be a £2,000 annual limit. Anything above that, so you can do more than 2,000, but there will be employee and employer national insurance on those contributions. So a quick question for you. How many income tax rates are Becky and I going to have to worry about in 2027-28? Any guesses? 10, purely for income tax. You think then you've got rates for national insurance, you've got more rates for corporation tax, got inheritance tax to worry about, but 10 purely for personal tax. Now, fortunately, we all use software for these things, but I still quite like a manual computation. And I quite like my juniors to be able to do a manual computation. And it'll be great testing them on this, particularly when things happen in different years. Now, with all those areas that we were talking about, so what's the impact? And I thought you'd be interested to know in the impact. Now, if you can read the slide, the one thing you're going to see straight away is where does the money come from? Freezing of allowances. So where I was saying I was looking at the budget report and they've got details of the impact of every policy change on there, you can see it a mile off that the freezing of allowances raises the most money. Now, I've put it from years 3, 4, and 5, because obviously they changed it to extend it to 2031. So that's why it's those 3 years that policy change raises significant amounts. Now, there's lots of other changes that have happened, but if you go through, they're quite minor in comparison to that one area. Now, this is why you can see that growth and then the freezing of allowances basically means that everyone's going to pay more tax. So the idea that they haven't actually changed tax rates might be questionable. The increasing, if we just have a look at those increase in tax rates, you compare the amounts that they're recovering in comparison to the freezing of the allowances, you can see where the high amounts are coming in. The one thing I thought you'd probably find interesting, though, and this is why I mentioned the salary sacrifice, is just how much money they will make from that one small area of salary sacrifice. There is a big take coming from that in 2029. And this is where you will see in those later years, that's why you look at it and think, actually, in those later years, the tax take goes up significantly. 2030, 31, expensive. So what other changes did they mention? There were lots. Now, Becky actually printed out a lot of the reports for me so that I could read them all through. There are lots and lots of announcements. Many of them were minor, insignificant, or pretty specific to a certain area. Some of the wider ones, though. So with businesses, they can claim something called capital allowances where you buy plant and machinery. You have something at the moment called a writing down allowance. The current rate is 18%. That is dropping to 14%. We're also introducing a new first-year allowance at 40% from April 2026 as well. Now, for a lot of businesses that we deal with, this is going to have no impact at all because we've got something called annual investment allowance. So where you are buying plant and machinery, fixtures and fittings, you'll still be able to claim 100% relief. So you won't need to worry about those two changes. It's much more for the bigger businesses, that one. The other thing they mentioned, which I think is probably appropriate for everybody, is the ISA limit. Now, if you listen to her speech, she made it very clear the ISA limit would be maintained at £20,000. So she wasn't dropping the ISA limit. What she was doing, though, was saying that you'll only be able to invest £12,000 into a cash ISA. The balance would have to go into a stocks and shares ISA. All right. So I thought I'd put one little quirk at the bottom so you could see the areas that were announced actually on Wednesday. So this one was what I would call a slightly obscure one. So notional tax credit on dividends received by non-residents will be abolished. So this is what I would call a small area, and we had probably 30 of them, of these little insignificant ones to go through. Now, I can't cover them all today, and you probably don't want to hear about them. So we're going to run through what hasn't changed. So after all of that, you think, God, that was quite a lot of change. Actually, it's not too bad. So our normal income tax rates on earned income, they're the same. 20%, 40%, 45%. Corporation tax rates, you may have heard us say that they weren't changing the corporation tax rates. So we've still got the small company rate, 19%, and the main company rate of 25%, and then we've got a marginal rate in between those. VAT. Now, VAT hasn't changed for quite some time, so we've still got VAT at 20%. And as I mentioned before, we've still got that annual investment allowance, which is £1 million and has been for a few years. So there's a fair few things that haven't changed as well. Tom's going to run through a lot more of the things that have changed in relation to capital taxes in a minute. But I wanted to run through a few other points. The biggest one, as I was going through this, I haven't had any more time to run through everything that changed just over a year ago. Now, you may remember the budget just over a year ago. There was quite a lot of change going on. Don't forget about that. It's important. Tom's going to run through a lot more of those areas in a minute, particularly in relation to inheritance tax, where we saw significant change just over a year ago. And this final point is one that I thought is good to be aware of. As I'm running through the numbers as to where the tax money is coming from, one of the headings in the list was HMRC, further measures to close the tax gap. So what does that mean, further measures to close the tax gap? The government have always thought that there's a difference between the amount of tax paid in comparison to the amount of tax that should be paid. So there's a lot in the report about, one, collection of taxes. So that's where notification has been made of tax and they're just not recovering it. They are going to be putting money into collection, and you can see that HMRC debt collection route is going to be quite heavy-handed. The other area, they are looking at inquiry areas, and they are going to be spending money on technology for focused inquiries to close that tax gap. Now, to give you an idea of the numbers, I did add it up over that 5-year forecast, and they are expecting to raise £7.38 billion through those further measures. I still think that's an area that we are going to see more of in relation to targeted inquiries. Something for you all to think about. On that note, I'm going to pass over to Tom.
Good morning, everyone. My microphone is on. Excellent. Hello. Thanks so much for joining me. My name's Tom Chiffers. I'm a partner at Clarke Willmott, and I specialise in inheritance tax, which is where we're going to start. So I seem to spend most of my waking hours thinking or talking about inheritance tax. Now, I did, as Amanda said, we had lots of rumours, lots of leaks. I don't think I could look at a newspaper or talk to a client or talk to, in fact, anyone without someone telling me another rumour they'd heard about this budget. One of the, I'm going to say disadvantages probably, of having the budget so late. The irony is this evening it's our Christmas meal for our team. So usually it's supposed to be an autumn budget, isn't it? But we've got a Christmas meal tonight. So you can see how the two things have sort of come together, unfortunately. But is you've got lots of time for rumours, lots of time for speculation, lots of time for leaks, or lots of time to test something and then change your mind. Anyway, inheritance tax, for those who don't know, is charged usually when a person dies. All your assets are valued. You're subject to inheritance tax at 40% on the value above your allowances. The nil rate bound allowance, that's the most important one. That's the one everyone gets. That's £325,000. Then from 2014, we had an extra allowance, the residence nil rate bound allowance, which is £175,000. What that means is if you're a married couple, you've got children, you've got a house, total allowance is £1 million. Also, those allowances, since 2010, if you didn't use them when you died, your surviving spouse can use them. Transferable nil rate bound. So that's well established. I'll come back to that, why that's important in a moment. But it's really well established that you can, if you don't use it, you can transfer it over. The reason that they introduced that was because a lot of solicitors like me, you did a lot of this when I was a trainee, you could put in place arrangements to make sure you use that allowance when you died without disadvantaging your spouse. So 2010, they changed the rules to mean that everyone can transfer the allowance without having to come and see someone like me. So what have they announced the changes? Well, we had probably the biggest amount of changes last October that we've ever had since inheritance tax was introduced back in 1985. So I thought it was unlikely there was going to be anything on that scale, and there wasn't. Very, very small changes, but significant changes. So, as I mentioned, we've had the nil rate band allowance, 325. That's been the rate since 2010, the year I qualified as a solicitor. They announced on Wednesday that it's going to be fixed now until 2030. 2031. So it was last year it was announced it was going to be 2030, but now it's going to be 2031. So we're going to have 21 years of or 22 years rather, of an allowance that's been fixed. So you think how much house prices have gone up in that time, how much everything's gone up in that time, but the allowance has been fixed. So they've added an extra year. That's going to make a big difference. That means that a lot more people, just as Amanda was talking about for income tax, that phrase we used to hear a lot in the last government, fiscal drag, is going to drag a lot more people into inheritance tax. So the figures at the bottom of the one that I quoted last year, which means we're going to have a whole load of extra people who wouldn't normally have paid inheritance tax, are going to now start to pay inheritance tax. And just as Amanda said, that difference is going to be felt not necessarily today, but certainly over the next 5 or 6 years as time goes on. And as they expect growth and inflation to keep going on the same rates, we're really going to see the difference, or rather individuals are going to see the difference because a lot more of them are going to pay inheritance tax. So a very significant change in terms of tax, but not really doing anything with the rules. They're just kicking that allowance further into the future. So how much is that going to raise? Well, nothing immediately, because they'd already announced last October that it wasn't going to go up until 2030, but in 2031, that's going to be another £130 million worth of inheritance tax. Inheritance tax is intended to raise, or expected to raise, about 14 billion by that time. So they've added a little bit extra on the top. So, as I mentioned, really, really significant changes last October, certainly for me, who advised a lot of farmers and landowners. You will have seen an awful lot of attention in the press, a lot of protests, as there were on Wednesday, a lot of work done by people like the NFU and the CLA and all those sorts of people, very, very unpopular with farmers. But they announced that last October that reliefs that apply for farmers and landowners, so agricultural and business property relief, those are going to continue, but they'll be capped, or rather there'll be an allowance at which they'll apply in full, and that's £1 million. Now, very, very unpopular, because anyone who is a farmer or knows a farmer or a landowner, £1 million doesn't go very far when house prices are as they are, or machinery prices or cattle prices as they are. So what the rules meant was that first £1 million, you benefit from those reliefs in full. Anything above £1 million, you still benefit from the reliefs, but only at 50%. So that means you're paying inheritance tax at a real rate of 20%. So what did they announce on Wednesday? Well, I'll just go over quickly what the other things that they announced. So those allowances, as they clarified earlier on in spring, that allowance will apply any assets you own or any assets you give away in the 7 years before your death. So basically treating it like the nil rate band allowance that we've had for such a long time. So what are the changes that they've announced? So as I mentioned, since 2010, or 2008 rather, you could transfer any unused nil rate band allowance from one spouse to another. But last October they announced that you wouldn't be able to transfer any unused agricultural or business property relief allowance between spouses. So you either used that allowance or you lost it. Now, quite rightly, a lot of people pointed out that that was a little unfair, seeing as though there might be farmers or landowners who were themselves a widow or a widower. They'd lost their spouse years before and hadn't done any planning because these rules didn't exist when they're doing their planning. Or their spouse might die before the 5th of April 2026 and they wouldn't have had a chance to update their will. So it's seen as quite unfair. One of the many things that the NFU, the CLA and everyone else were pressurising the government to do is to change the arrangement so that you could, just like with the normal nil rate band allowance, transfer any allowance from first spouse to die to the survivor. Well, they have listened and they have done that. So now, when that allowance is introduced next April, you will be able to transfer any unused allowance from first spouse to die to the survivor. And that's the case whenever that first spouse has died. So whether they died pre 5th of April 2026 or pre the 24th of October 2025, whenever, if they've died and the surviving spouse dies post 6th of April 2026, you'll be able to utilise that allowance. So what that means is if you are a widow or a widower, then you will have double the allowance. You'll have £2 million worth of allowance to apply to your agricultural business property relief eligible assets. So doubling that allowance for you. Anything under that is taxed at 0%. Anything above that, taxed at 20%. So how much will this cost the government? Well, quite a bit, actually. They estimate that it's going to cost them £70 million a year, which is actually 14% of what they'd estimated the changes will bring them. So fairly significant change to the £500 million that it was going to generate by 2030. The other change they've announced for agriculture and business property relief assets is that if you have a trust or any sort of entity that's not resident in this country, but owns agricultural property that is resident here, you're going to be subject to UK inheritance tax. So again, there's been a lot of changes about non-domiciled individuals and whether they're considered domicile or subject to tax in this country. This is another change. So if you've got land here, then you're paying inheritance tax whether you're resident here or not. So the other big change, as I mentioned, really significant change for inheritance tax last October. The other one, which took a lot of people by surprise, was the way that pensions are taxed. So we've had years and years, decades even, of people being incentivized to put more and more in their pension. They were seen not only as a tax efficient way of adding assets during your lifetime, but also a way of passing things on to the next generation, because pensions could carry on. They were sort of turning into sort of wealth management trust arrangements. Well, that changed to some extent last October when they said actually pensions are going to be subject to inheritance tax. So they're all from the 6th of April 2027, your pension pot will be subject to inheritance tax. A lot of people said, well, how is that going to work? Because an executor's job is to value a person's assets, tell the revenue how much it's worth and pay the tax. The difference with the pension is that's administered by the pension administrator who doesn't follow what's in a person's will. They administer the pension however they're told to administer it or however they decide to administer it. So how are those two roles going to work? How is the executor going to get the pension administrator to pay the tax and or vice versa? Well, they gave a little bit of information in the spring. They said, actually, it won't be the pension administrator, it's the executor who's got to do it. But it still wasn't very much information. They've clarified it a little bit now, which to say that the personal representative, so the executor, they have got the power to force the pension administrator to withhold half of the value of that fund in order to pay the inheritance tax. One bit that I couldn't quite work out, which it implies to me, is that that inheritance tax could be for everything. So it could be that the executor is able to utilise funds within the pension to pay the tax over the whole estate. But again, still not very much information, and they've still got a little bit of time to clarify that, not due to come in until the 6th of April 2027. So, capital gains tax, another one that a lot of rumours about, a lot of people worried in the run-up to Wednesday. A lot of people did lots of things because they were worried about capital gains tax going up. Well, it hasn't. The rates in the allowances haven't been changed at all. No difference. No reliefs also have been changed. So holdover relief, rollover relief, they're just as they were. One thing that has changed is employee-owned trusts. So those are put in place a few years ago to encourage business owners to transfer ownership to a trust which was used to benefit their employees, try and spread some of that wealth. So if people are selling a business or they're passing a business on, employees have got an interest and they can benefit. The advantage was for the business owner, they could pay no capital gains tax, no inheritance tax. Well, the government announced on Wednesday that actually the scheme was too popular. We used too much. It saved too much tax. So obviously it's got to be changed. It was estimated to save $2 billion a year, which is 20 times as much as they expected. That's the trouble with these things. If they're too good, too many people use it, then they scrap it, which is what they haven't scrapped this, but they've reduced the effectiveness. So now employee-owned trusts still exist. You can still get some tax benefit, but they've just cut the tax benefit in half. So you only get 50% relief, which means you pay a real rate of capital gains tax at 12%. Right. Something new to talk about. Another rumour that was really persistent It was the one that kept going, kept being mentioned. People kept mentioning it to me. And almost all the time I said, well, I can't see how this would work because council tax doesn't really work very effectively. So how is this going to work? Well, they did it. They did introduce it. So they've called it the high value council tax surcharge, or what everyone will call it is the mansion tax. So it's going to be introduced from April 2028. It's not council tax. That's the first thing to say. But it is going to be levied on properties worth over 2 million. And it will be based, so council tax, the reason I was so pessimistic, if anyone mentioned this to me in the run-up to Wednesday, was that the council tax rates are all based on valuations from 1991. And various governments have talked about, proposed changes to it. Every time it's been felt that it was too difficult or too unpopular, and the can just got kicked well and truly down the road and it ignored. Well, now they're saying this new tax will be introduced. It will be based on the same principle as council tax, insofar as it's an annual charge based on the value of your property. Interestingly, unlike council tax, it's not payable by the occupier, it's payable by the person who owns the property. Social housing, obviously, will be excluded. It's going to be collected by local authorities alongside council tax, but crucially, not paid to local authorities. It's going to be paid to central government. The government are going to use the levers that they use for council tax, i.e. the valuations office, to revalue all these properties, what they've called a targeted valuation exercise. I'm not sure how that's going to work in principle, but nonetheless, a lot of these properties worth in excess of 2 million are going to be valued. And then from 2029, 2030, there's going to be a revaluation every 5 years. Again, if you know very much about the valuations office, you'll know that they don't have enough staff, they don't have enough people. So the idea that they're going to go out and value all these extra properties seems a bit optimistic. Again, lots of consultation to be started and done because property ownership is complex. There are trusts, there are companies, there are multiple owners, all those sorts of things. Those are in the to be confirmed category. So how they're going to wrestle with those, I think we'll wait and see. But I suspect this is going to perhaps come down to one of those taxes that costs more than it receives, because it can be difficult to administer, it's going to be expensive to administer, might not generate very much. So the rates. So if you're 2 to 2.5, you pay a fixed flat amount of 2,500 a year, and then if your property's worth in excess of 5 million, you pay a fixed amount of 7,500 per year. It's supposed to generate fair amounts, they estimate. So 435 million by 2031. So not a hugely significant tax, but nonetheless more significant than you might have thought. So I'm going to finish, before we hand over to questions, with this slide, which goes back to something that Amanda said. The writing's too small, sadly, for you to see, but the bar on the far left, as you're looking at it, that is, says underneath it, fiscal creep. So that's basically where all of the taxes are going to come from in this budget, where the money's going to be generated from. And obviously, the higher the bar, the more tax. So it goes right up to 13 billion at the top there. Almost, by far and away, the biggest, probably as big as almost as everything else put together, is all down to those allowances being fixed. It doesn't come from all the things that get the headlines. It doesn't come from everything else. It's just down to those allowances being fixed now until 2031, and people continuing to earn more, wages going up, properties going up in value, assets going up in value. So I thought that would be a good one to finish, because we spend a lot of time, and I certainly do, talking about things like inheritance tax and capital gains tax, but actually the tax is really being generated by people doing nothing at all, just allowing the economy to work and grow, and then those allowances doing the hard yards. Right, thank you very much. Hand back over to Becky. Have some questions.
Well, thank you very much to both Amanda and Tom for taking us through what was in the budget. So it just leaves us to say, has anyone got any questions for them? Yes?
Question helped by ISAs sit within that?
Okay, just going to repeat the question for everybody at home. So the question was about ISAs and how the rules fit within the changes to lifetime and help to buy ISAs.
I don't either.
I'm not sure. I don't know. Sorry.
Okay, that's definitely one that we'll have to come back to you on. Yes?
Question on the mansion tax. So where a company owns a residential property, which is currently subject to ATED, is this going to be an additional annual charge for them, so they'll have 2 annual payments?
Yeah, I didn't put that in the slide. Sorry, I'll just repeat the question. The question was, will this be charged in addition to ATED, which is, I didn't put it in the slide, but the answer is yes. They've said they're not going to get rid of ATED. That's going to continue as it is before. But I suppose the interaction between the two, that will perhaps be part of the consultation. But they've already said, yeah, we're not scrapping it. It's still going to apply.
Any other questions? Yes.
Yeah, just going back to the figures, particularly on salary sacrifice. I mean, surely that's a finger in the wind exercise about how much it's going to raise. I mean, how can they be? I mean, this is what annoys me about all this sort of tinkering around the edges. It's just not very predictable, and I don't know how accurate the OBR forecasts are. It's probably a question you can't really answer, but I mean, is there a sort of margin of error quoted in these figures? Because I think it must be pretty large.
Yeah, so just to repeat the question, is the OBR report really, how much variation do they put in there for finger in the air items? Like with the salary sacrifice, where they're getting their information from is the real-time information that is provided already. So with payroll, as it's being uploaded, it uploads that sort of information. You're right, with any of the OBR reports, if you read them year after year after year, they are changed every time. They update their predictions. Yes, the figures they're putting in there, they're quite specific figures. They can't be that specific, so there is a degree that they're taking into of this is what we think it's going to be. Overall, do they normally get it fairly right? Within reason, yeah. So they know where the money is likely to come from. What you'll find, though, is where a lot of these announcements are made, people then plan. And that's the thing, is they can't take into account what else people might do instead. So that's a difficult part of actually forecasting forward. They've got a general idea of what they're doing, so they're likely to be sort of in the right realms, but there is a degree to them where they're not going to get it bang on each time. Yeah.
Any more questions?
Stuart. So I'll repeat the question. So Stuart asked for farmers and landowners, are we changing the way that we advise people about their wills? So in answer to that question, Stuart, yes, to some extent. So before Wednesday, we were telling everyone to make sure they used that allowance. So using something that we've always done, which is make sure you capture those reliefs when you got them. So what we would call an exempt asset trust. So that has definitely changed over the last year. I would still think that's good advice because it's still useful, and I always think the simplest advice is the best. If you've got reliefs that are available for inheritance tax, grab hold of them, capture them. Don't run the risk of just allowing everything to go to the survivor, because although these changes aren't very popular, they might get worse in the future. So you've still got to, if you've got the relief, utilise it. Make sure not everything ends up with the surviving spouse, because you don't know what the circumstances, either the tax regime or their own circumstances might be like. Thanks, Joe.
Any more? Yes.
Amanda mentioned on the ISAs, £12,000 cash ISA limit and 8,000 in stocks and shares. Is it correct? If you're over 65, you've still got freedom to put it all in cash or all in stocks and shares?
Yes, so just to repeat, that was about ISAs and the allowances and whether there were differences between the under and over 65s.
And the simple answer is yes. Yeah, so the rules change for under 65s. For those over 65, yes, you'll still be able to do the 20,000 into cash ISA.
Yes.
If you have mixed sources of income, is the tax rate of 22% going to counter the first bit, the tax-free bit, or at the other end, the taxable bit?
Right, so this was a question about the changes in tax rates and how it applies and interacts with the tax-free allowance.
We haven't seen the examples yet. No, there was a comment in there that allowances would actually go against the lower 20% first, but we haven't seen the detailed calculations as to how it's going to go. So I'm not sure.
Yes.
Amanda, just one for you on that cash ISA and the equity element of it. Have you picked up anywhere whether she's trying to restrict the investment of 8,000 into the UK markets, or can that money be moved offshore into offshore equities?
So this was a question again on ISAs and whether the allowance in investments had to be restricted to the UK or if it could be overseas.
I've not seen anything on it, so I'm actually just going to check. Have either of you?
No, not seen anything.
No, I haven't seen that yet. I don't know if anyone else in the room has seen anything on that.
She was banging on about investment in the UK industry.
She did go on about UK investment throughout, but there certainly wasn't something that I saw as I was reading through anything. Any other questions?
Any other questions? Yes.
The government's primary aim, they say, in their economic policies is to drive growth. Did you detect anything in the budget that's going to encourage such?
Oh, this question was about the Chancellor's speech about wanting to drive growth and what was actually in the budget to drive growth.
I am racking my brain.
Yeah, me too.
The fact that the UK is very good at getting on with it. That's probably what I can say. I can't think of anything else.
No, I didn't see. There was nothing, there's very little by way of incentivisation, shall we say. So I'd say probably no.
Any more?
Any other questions?
Any other questions? Do we have any from anyone online? No? Okay, well, I think that is just about us then. And thank you everybody for attending and everybody who's watching at home. Just like to say thank you again to Amanda and Tom and to the racecourse for hosting us, and have a lovely day.
Thank you.